This video is a continuation of our discussion of accounting for bad debts. If you haven't already, please watch the video on accounting and bad debts using the percentage of sales method. In this video, we're going to be using the percentage of receivables method in order to account for bad debts. We have the same situation here with Adam's Coffee Shop as we did before in the previous video. In this video, we're going to walk through how the accounting for accounts receivable and bad debts works with regard to a different method of estimation. As we said in the previous video, the first thing that we have to do when we were talking about accounting for bad debts is estimate. We have two methods we can use to do that: percentage of sales or percentage of receivables. In this video, we're going to be walking through the percentage of receivables method of accounting for accounts receivable and bad debts. So the first thing we did in the previous video, as we'll do here, is to record the sales for the month of January. January sales are all on account, and the January sales were $5,145. We get to record accounts receivable as our customers owe us money, and we get to record $5,145 of sales revenue. Then, during the month of January, we collected some of our receivables. We collected in cash $1,955 of our accounts receivable, and we were able to write off then $1,955 of what people owed us. Then, at the end of the month, we have to come up with the amount of bad debt expense that we need to record for the month of January. Now, the percentage of sales method uses a simple formula. You take the credit sales for the month times the percentage you think is uncollectible, and you record your entry. When we get to the percentage of receivables method, it's a little bit different. And so we're going to scroll down here to the bottom, and we're going to look at what's called an aging schedule. When we do percentage of receivables, we typically look at how old our receivables are. Because the logic is, the longer somebody has owed us money, the less likely they are to pay. And so we take our accounts receivable balances at the end of the period. So here we have the accounts receivable amounts, right? The amounts people owe us. And we see here that Joe's Joe Depot owes us $500. Callie's Cappuccino Castle, $175. Avery's Americanos, $1,000. Evelyn's Espresso, $600. And Paul's Pour Over Place, $915. So these are the amounts that our customers owe us. And what we want to know is, how long have they owed us this money? And so since this is the first month, these amounts have been outstanding. Okay, up here at the top, days outstanding. These amounts have been outstanding between 0 and 30 days. If they purchased stuff from us January 1, now it's January 31, it's been 30 days. If they purchased stuff from us in the middle of the month, it hasn't quite been 30 days yet. And so I'm going to break out my total accounts receivable balance, $3,190 at the end of January, and I'm going to break it out by how old it is. Okay? And then for each category of age that I have, and I can come up, companies can make these categories whatever they want to. For each category of age that I have, I'm going to have a percentage that I believe I will not collect from the stuff in each category. Now, what do we see about the percentages as you go from left to right? As we go from shorter amounts of time owed to us to longer amounts of time owed to us, right? What happens to these percentages? Well, they're going to go up. Because again, the longer somebody's owed us money, the less likely we believe we are to collect from them. And so at the end of January, I've only got one category that has any values in it. And so I'm going to record my entry here. I am going to calculate by taking how much is in each one of these buckets, if you will, times the percentage. So I've got $3,190 owed to me. That's 0 to 30 days outstanding. I think 5% of what's 0 to 30 is going to be uncollectible. And so my amount here, if I calculate it, is $159.50. Now, we may just round this up, make it an even $160, just for the ease of our work here. So the total amount that I think will not be collected is $160 of my $3,190. So I go to my account. The next thing I want to do is I want to look at my allowance for doubtful accounts. And my allowance for doubtful accounts T account. This T account represents the amount believed uncollectible. And so that amount that I believe I will not collect is right here. That's what we calculated with this aging schedule. So I'm going to look at my T account and I'm going to say, all right, that is the amount that I want to have in this account at the end of the period. So the end of January. In order to get to that, I need to know, what did I have at the beginning? Or what is my, I should say not beginning, but what is my, let me get back to my pen. What is my unadjusted amount in this account? And right now it's 0 because I haven't done anything, right? So in order to get to 160 as the balance, with the beginning or unadjusted balance here of 0, I need to record an entry for $160. So we're going to scroll back up to our journal. My journal entry here would be bad debt expense. $160. And allowance for doubtful accounts. I'm going to abbreviate it. For $160. And that's where I'd finish January. I would have my allowance for doubtful accounts account with a balance of $160 from transaction 3, right, that we just recorded. I'm going to record bad debt expense on my income statement of $160. And my accounts receivable balance, if I were looking at that T account, would still be the $3,190. So, that's January. Come to February. In February, we make some additional sales. So here's February, transaction 1. We make some sales. Accounts receivable, $3,255. Sales revenue, $3,255. I determine that one of my customers is not going to pay me. We talked about how at the end of January, Callie's Cappuccino Castle owed us $175. That was her outstanding balance to us at the end of January. We determined that she went bankrupt. She's not going to pay us. So what do? Again, we said the process, right, is to first estimate, and second, once we determine specific customers who are not going to pay us, then we write off their accounts. So we need to write off Callie's Cappuccino Castle's accounts receivable balance. So how do we do that? Well, as we did in the previous video, allowance for doubtful accounts will be debited for $175, and we get rid of accounts receivable for Callie's Cappuccino Castle, right? $175. So that's what happens here at the beginning of February. And then I'm going to collect some money from my customers, okay, from these sales. I'm going to collect from multiple customers. I'm going to collect from Logan's Latte Lounge. We can highlight these here. I'm going to collect from them. I'm going to collect from Molly's Mocha Mansion. I'm going to collect from Trips Cold Drips and Dwight's Flat Whites. And so I'm going to collect a total of $15.30 in cash, and I can get rid of those customers' accounts receivable balances. Then, at the end of the month, I have to again estimate how much bad debt expense I need to record in order to abide by the matching principle and to show my receivables at their net realizable value. So we're going to scroll down here to the bottom, and here we have the aging schedule for February. Joe's Joe Depot, who purchased $500 worth of stuff from us in January, still has not paid us for that $500 worth of stuff. So now they are outstanding 31 to 60 days of that amount that they owe us. They purchased some additional stuff from us in February, so that stuff is 0 to 30 days outstanding, and the total amount they owe us then is $700. So as you can see, this aging schedule, right, is going to take the total amount that customers owe us, okay, the accounts receivable amount, right, the total value, and it's going to classify it by how old it is, okay. Each group then has its own percentage, okay, each age category. And so if we do the math for this aging schedule, the estimated uncollectible amount from my 0 to 30 day receivables is $86.25. The amount expected to be uncollectible from my stuff that is 31 to 60 days old is $301.50. So if we want to round these just to be easier with the numbers, we can say 86 here and 302 here. So in total, how much do I expect will be uncollectible? If I add these two together, I'm going to get $388. $388 is the amount that I do not expect to collect from my customers. And so I need to look at my allowance for doubtful accounts balance. My allowance for doubtful accounts balance, when I started this month, if we look at the previous month, we finished with $160 in that account. We then said that we were going to write off $175 from Callie's Cappuccino Castle. And so as it stands, our unadjusted balance is a debit balance of $15. Now, you say, is that okay? Well, allowance for doubtful accounts is a contra asset, which means it needs to have a credit balance at the end of the period. But in the middle, it is possible for it to have a debit balance. Well, why is that? Well, the balance in here on the credit side reflects our estimate. And the debit side reflects our write-offs. And so if we write off more than we estimated we would, as is the case here, we're going to have a debit balance. But eventually we're going to have to re-estimate, which is what we're trying to do now. And since we have to re-estimate, it's going to push us back over to the credit side at the end. So if we look at this and we say again that the amount we have here in this schedule, right, this amount that we calculated, that is my allowance for doubtful accounts balance. Then I am going to record a credit to this account so that I have in my allowance for doubtful accounts at the end of the period $388. That is going to be my adjusted balance. The question is, how much? How much do I need to record to get there? In order to get there, I am going to have to record a credit of $403. That's going to be the amount I need to record in my entry. So if we go to our journal, I'm recording the adjustment for bad debts. I'm going to record a debit to bad debt expense for $403 and a credit to allowance for doubtful accounts for $403. Then when I go post that down in my journal, down in my T account, right? This was transaction 4, right? I'm going to have a balance of $388, which matches the balance from my aging schedule. My accounts receivable account is going to have a balance of $4,740 as reflected on my aging schedule. And that's what I'm going to report on my financial statements. So, at the end of February, what will my financial statements look like? What will my balance sheet look like with regard to my receivables? I'm going to have assets on my balance sheet. Underneath of that, I'm going to report my current assets. First of which is always cash, which again for this illustration we don't have a number. Then accounts receivable. Well, $4,740. After my accounts receivable, I'm going to subtract the amount of allowance for doubtful accounts, which was $388. And that's going to leave me with accounts receivable, net of my allowance, of $4,352. That, again, is what we call the net realizable value. After my receivables here, I would have my inventory, my supplies, and my prepaid expenses. Those would give me total current assets. So again, we don't know what these numbers are that would fill these spots because our illustration doesn't have that. But that's what it would look like. That's what my current asset section would essentially look like. Now, in reality, most businesses only report this number on their financial statements. They only report the the accounts receivable net of the allowance on their books, on the face of the balance sheet. Oftentimes, companies will give more information in the notes to the financial statements, but right on the face, typically we're just going to see the one line. So we're going to take a look at Under Armour again. This is their 2019 annual report information, and I pulled out a couple things related to receivables just to highlight the connection between what we looked at in terms of the percentage of receivables, percentage of sales, methods, and bad debts, and then the balance sheet with a real example. So Under Armour's balance sheet here for the last year, December 31st, 2019 to December 31st, 2018, shows us accounts receivable net. So on this balance sheet, which is in thousands, Under Armour's customers owed them $708 million in the end of last year and $652 million at the end of the year before. These numbers are net, meaning that they are net of the allowance for doubtful accounts. So the numbers they're presenting here are the numbers that they believe they will collect from their customers. Now, on a couple other pages in the notes to the financial statements after the balance sheet, they talk about their allowance for doubtful accounts, and they say, we make ongoing estimates relating to the collectability of accounts receivable and maintain an allowance for estimated losses resulting from the inability of our customers to make required payments. In determining the amount of the reserve, we consider historical levels of credit losses and significant economic developments within the retail environment that could impact the ability of our customers to pay outstanding balances and make judgment about the creditworthiness of significant customers based on ongoing credit evaluations. Because we cannot predict future changes in the financial stability of our customers, actual future losses from uncollectible accounts may differ from estimates. So there again, they may estimate and the write-offs might be more than the estimates or less than the estimates. If the financial condition of customers were to deteriorate, resulting in their inability to make payments, a larger reserve might be required. They would have to adjust their uncollectible percentages in their calculations. In the event we determine a smaller or larger reserve is appropriate, we would record a benefit or charge to selling, general, and administrative expenses in the period in which such a determination was made. As of December 31st of 2019 and 2018, the allowance for doubtful accounts was $15 million and $22 million, respectively. So they are saying that as of this past year, the end of December of 2019, they expected not to collect $15 million worth of what their customers owed them. That seems like a big amount, right? $15 million of the amount that they were owed. So if we go back to their balance sheet and we see that they were owed $708 million at the end of the previous year, what does that look like? Well, if we add back the $15 million that they didn't expect to collect, they are actually owed $723 million, somewhere around there. But $15 million is expected not to be collected, so we have a balance left of $708. So what does that mean? Well, that seems like a pretty significant amount, but we'd have to compare it to their past estimates. We'd have to compare it to other companies to really make a value judgment on that number. So we're looking at this just to show kind of an example of how accounting for accounts receivable is done in real life.